It's good to see you both. And Matt, I'll begin with you. You know, I guess it's important to have a sense of how bad the information could be, because it's going to look really bad. And I guess the idea is, you know, to try to take the sting out of it when it hits, so people understand, look, this is the size of the hit we're potentially talking about, but here are the things that we're doing to try to get it back down as quickly as possible, right?
Yeah, there's no question, and you know, it's good. You want to hear those instead of those gradual things that keep rolling out. Well, it's going to be 10% unemployment, 20%. Let's get the worst case scenario out there, so the markets can price it in, as you just talked about on the earlier segment. That a lot of these things are starting to get priced in. But one of the things that also does concern me, though, is that it's going to make it, you know, give us the chance of any kind of V-shaped recovery is going to be very tough. With that many people losing their jobs, whether it's the right number or something less, and the concern that the coronavirus could hit us again in next fall, so people are worried about, geez, I might get laid off again, even if they get their job back, is going to keep them from jumping back in a big way. And of course, the consumer is a very important part of our economy. You
know, Matt, what are you looking at right now? I know obviously you pay a lot of close attention to kind of the market feel and a lot of the technicals and a lot of different things like that. What jumps out to you at the moment?
Well, I mean, one of the things is the Russell 2000. Well, two things. Number one is that when this forced selling, comes to an end like it did, 2 weeks ago, it was just massive in basically every single market. Now that that's subsided, the markets bounce back, kind of, hit a vacuum and bounce back. So what happens next? And one of the things I'm looking is the small cap Russell 2000. That, is bounced back very nicely. It's been a great leading indicator for many years, and especially the last few years. If that rolls back over and takes out its 2016 lows, that's going to be a problem. If it can hold, it should be a good sign.
And Hugh, you've been looking at the history of how the market and the economy have reacted to past pandemics. What does that tell you about the episode we're going through now?
Well, it tells you the most important thing, which everybody should keep in mind, and that is whether you're looking at pandemics, epidemics, whether you're looking at bear markets or corrections, the one thing they all have in common is they end. And that's really important. Now, of course, every one of them is different, so you don't know exactly how they're going to end. So you've got to really look at everyone differently. And quite frankly, I've been doing that, and especially looking at the pandemics, the Asian flu, the Hong Kong flu, the Spanish flu, and then a lot of the epidemics since 1980. It's hard to learn something from them, quite frankly, except other than the fact that they end, is that I would guess this one's going to be somewhat short-lived. In other words, somewhere in the 6 to 8 months when we talk about the decline in stock prices. I think when we talk about the decline in stock prices, looking at history, that the answer is we've probably seen the worst. That's very important. We may go down, and in Wall Street says retest the lows, and that's a real possibility. But I think we'll do that in the third quarter, but I think that'll be it. The one thing that we're not is we've got more duration to this. So I wouldn't be surprised to see for the next, say, 4 to 6 months, a period of a sort of a trendless and very volatile market, setting the stage for sometime in the third quarter to start a recovery towards what's going to be a much better economic and earnings environment in 2021. This doesn't look like it's going to last a real long time when I look at history.
You look at sectors, healthcare is one of them, utilities, consumer staples, and I see a big focus on dividends and dividend yields. I mean, that's such a moving target right now. Do you feel that those are the areas you can kind of most count on?
Kelly, you got to really look at financial market history. And financial market history is very clear. They're defensive sectors, things that work well in a bear market, which is what we're in. Consumer staples, healthcare, utilities, they work well. What I'm saying is a trendless and volatile market, and what I'm saying is keep your defense on the field. In other words, I think you still have to have your guard up just in case I'm wrong and in case the market not only retests the lows but goes even lower. I don't think that's in the cards, but keep your defense on the field. When we see things like Matt's talking about, such as we see small cap stocks start to perform well, we start to see signs from the financial markets that things are turning, then you can go from defense to offense. But it's too early to do that. That will come, I think, in the third quarter when we're looking at 2021.
Matt, I'll give you a quick last word on that before we go.
Yeah, and I agree with you. And also some of the technology stocks, which have always been really, riskier names and tend to go down a lot more. But some of the high quality names like Apple and Microsoft, and even I'm sorry, well,
Amazon,
some of those big
Netflix,
names.
yep. Facebook.
Exactly. I'm sorry. These ones have not underperformed this time around because they're such an integral part of our economy. Unlike it used to be, we're not being run by the generals anymore, General Electric, General Motors. We're running by these key companies. Tech as a whole is still quite risky, but some of the big cap names, they're nowhere near as risky, and they actually can be a good defensive play in markets like this, which is a big change from the past.
Yeah, I blame Google for this whole alphabet thing. It trips me up every time. Guys, thank you both. It's good to see you today. Matt Maley and Hugh Johnson.